I think it's really prudent to understand where your likely exits will come from in terms of which kind of companies in some industries or some businesses you might create. There's very, very specific types of people are going to acquire you.
Welcome everyone to today's Nobody Studios exclusive live stream. And we're going to be talking about one of the most defining moments in a startup life cycle, the exit. And so I'm thrilled to be joined by two incredible guests, Mark McNally and Andy Walsh, who bring a wealth of experience to this topic. Welcome back. Great to see you both. Today we're going to unpack a lot. We're going to talk about strategies, challenges, and lessons learned in structuring exits. So let's just jump right in. And Andy, let's start with you today. Can you share a personal story about an exit that you were involved in? Maybe you could tell us about what made it successful or maybe even what made it challenging.
It was, I'd love to say that I was one for one, but it was my first company that I started that I exited from, which was humbling in a way, but, it took a lot of work. And it's interesting, the work that I do now, and the reason that I raise this is that it's we spend a lot of time thinking about that long-term game plan of where we want to get to, what are milestones, etc. In my own business, we bootstrapped it for the majority of the journey, and we're able to build a sustainable business, navigate those pieces. And the exit was never really part of our long-term plan, but it came sooner rather than later, which was approximately 6 years, I'd say, 7 years after we started the business. So pretty early, pretty humbling. But I think for me, the lessons in that, and we were really lucky that we had a strong group of advisors, but it's being prepared from day one. And that starts with your founders agreement. It starts with how you make decisions. It starts with thinking about your investment structure and what the rules and regulations are about that. I think from day one, you have to plan for the fact that you're going to have a potential exit and what that looks like, because there's a lot of dotting I's and crossing T's, but also a lot of big decisions that need to be made at that point. So planning in advance is probably the best advice I could give.
Thank you. I appreciate you sharing that. And you said something that I want to get deeper in as we kind of talk about these other questions. Is you said we hadn't planned for it. Right. Mm-hmm. It's just something that sort of came your way and it was a good opportunity. And then on the other hand, you're saying we have to be planned. We have to be prepared for that possibility to happen. Right. So I want to kind of talk a little bit more about that. And before we do that, though, Mark, how about you? Any stories that stand out in your mind?
I think to piggyback off what Andy just said, one of the things I believe is that companies don't get sold, they get bought. I mean, it's kind of what Andy was saying there is like they weren't expecting it or they weren't, trying to make it happen. Now, there are exceptions. You can certainly sell your company properly and there's a process you can go through. But in general, I don't believe you always find the best deals. I don't believe you have the right motivations. There are certain things that make a deal go through kind of seamlessly with the right kind of motivation, at least for founders and shareholders. And usually it's not being a situation where you're trying to sell a company which could be desperate, right? Now, the ways you can do a sell that take away the desperation is when there's I call it a stalking horse, when there's another option. Either you're about to raise more money or you could go public or you have another offer. Then there's ways to actually facilitate a structured process and getting other people to bid and be a part of possibly buying your company. But usually in the absence of one of those things, if you're just putting yourself out there to be bought, it doesn't end up well. So you're better off just being visionary and passionate about what you do and putting points on the board and having the industry talking about you and growing your numbers. And that's usually the best way to hit the radar. I always say that you'll get bought in that way, but there's still an art form to be noticed. And so a lot of people don't go through the process of at least thinking through, and maybe this is what I would say about the planning part that Andy was hitting at. I think it's really prudent to understand where your likely exits will come from in terms of which kind of companies in some industries or some businesses you might create. There's very, very specific types of people are going to acquire you. So having relationships with them, building good relationships with them, maybe even being part of their partnership programs, or, politely and friendly competing so that you're, causing disruption in their world. There's ways to be noticed and make sure that the idea of an acquisition isn't left to happenstance.
Yeah, thank you. And I really want, because you've been around the block a few times when it comes to exits, right? You and Andy both. And so really would love for you to share, some of the things that you've learned or some shortcuts that some founders can kind of keep in mind, right? And so let's take a step back. Let's talk about what are some of the things that founders should consider when deciding on their exit strategy as early in their startup journey. Right. So we're going to kind of back up and then work our way forward.
Yeah. So I think for me, being really clear with co-founders on what that looks like. There's rules you can put in place around drag and tag and forcing people. With my first startup, we actually set a minimum number from a sale price that we could do a drag and tag, because you can even get to a point where you're negotiating and get stuck with co-founders on what you want to sell the business for. So like the ability to be able to make sure that that's pretty seamless, I think is something that we were fortunate to have an advisor who was an attorney who specialized in M&A, and he gave us the foundations of a contract that allowed us to be nimble when we operated, but also allowed us to be buttoned up when we exited too. And there's always a lot of paperwork on an exit, but I think it made it more seamless than most. Compared to what I sort of heard about in market.
Yeah, Mark, did you want to add anything?
Yeah, again, there's so many stories. I'll share one I think is important. This isn't my personal story, but it's a close associate of mine I've done a lot of business with over the years. He was coming off a fresh exit that was hundreds of millions of dollars to a large technology company. They were basically almost on bankruptcy, and they luckily closed this monster deal that everybody was looking for and everybody was trying to compete for. So they suddenly hit the radar of a lot of big people going, whoa, where did these guys come from? But they were just literally on fumes when they got that deal across the line. So they were enjoying this little moment of sunlight. And, one of these big companies reached out and, kind of knew their story and said, hey, well, that was a really comeback, win, but got to admit, your technology is pretty cool. So maybe we can just, ease your pain and bring you into the mothership. That's kind of the tone. At that point, he recognized that they had a desire and a motivation to have the technology, and it would have taken them years to replicate that. Now, in big technology world, years is way more expensive than money. Playing catch up is incredibly painful. A lot of folks would have just curled up like a little kitty in their lap and started talking about, how do we make this happen? And he leaned into strength and said, oh, that wasn't a mistake, even though the first couple of years were hard. Like, we're going to go own this freaking industry, and we're going to eat your lunch. And then he went out and talked to investors and said, these guys want to acquire us. I'm not going to sell to these guys for pennies. We're going to sell to them for, wads of hundreds of dollars of bills. And they got this out of nowhere. But the most they'd raised up to that point was like $4 or $5 million. Out of nowhere, he raised $22 million from VCs who knew this big company wanted to acquire him. And so then the whole entire nature of the discussion changed. He basically said, I appreciate your interest. Let's stay in touch. I wish you guys the best of luck. We'll see you in the open market. And that's when the big technology company was like, oh my gosh, if these guys keep growing, they're going to eat up our market share. We're not going to be able to compete. They're going to raise even more money. They're going to become more expensive. And so their price point, and I end up, it happens, in hindsight, I actually got to know the person who drove the acquisition from the big technology company. So I actually got a chance over time and dinners and lunches to understand both sides of the equation. And the guy who drove the acquisition said, yeah, we thought we were going to get him for X. Everything changed in 3 to 5 months. And the technologists that I was working for at the big company were saying, get this at all costs, which in the big scheme of things was still, small money to them. But what they thought they were going to have to pay grew 6 or 7X in 5 months. And it was because of how that particular founder played that, in terms of making sure they had a very viable alternative, and it was not debatable. It was like you look at it and go, well, they have the capital now. They can really run hard for a couple of years. Like, what's their incentive to do this now? And so then you're able to have a different kind of discussion and debate. and negotiation. They were like, hey, we can see a lot of attractive, parts of being a part of your big mothership. However, we have these resources to run really hard for a couple of years, and maybe we create a $10 billion company. So why would we exit now? And you put the onus back on the buyer. The buyer always has to solve your problem. Now, again, that's why it's different if you're desperate. If you're desperate, a buyer will sense that, and they're going to give you a lowball offer. And I always think that's the worst situation to be in. But I think it's really important to understand those dynamics in terms of having alternatives, a viable alternative, and forcing them to make it so compelling that you can't say no.
Yeah, I was just having a conversation. I love that story that you shared, Mark, because it reminded me of a conversation I just had with another founder that was looking and considering whether or not to exit. A certain opportunity had come her way. And I told her the same thing. I go, it's good to understand the expectations, right, of everyone involved. And that might change over the time. But if you don't take the time to have that conversation, it's going to create more tension later on, right? And so I think that that's a great story that you shared. And Andy, I don't know, you were shaking your head. Did you want to add anything to what Mark was saying?
I love when, for whatever it is, whether it's an epiphany, whether it's external advice, but when you can sort of change the power dynamic in that relationship as well. And I think the comment that Mark made earlier around being bought and not selling, that sort of the psychology of sort of what you're doing is a negotiation in itself, right? Understanding sort of what you have and the value that has to someone else is not always necessarily financial. So I think being able to do that, because the build on that too is also what happens when you sell. I'm not sure if we're covering this in a further question, but the ability to do, if they're buying something that's technology and maybe they don't need all the people, if you're sort of locked in for 3 years, which is pretty common on an exit through an acquisition, then thinking about your role, do you want to stay there long term? Do you want to get out as fast as you can? Typically changes the value that you get out of it. Are they buying people versus product? I've seen acquisitions before where they can't poach the staff to go and work for them, so they buy the company and actually buy all the staff that they have and lock them in that way. So there's a lot of different ways that dynamic is set up, and I think that it's one of these things that's sort of held up as a success to exit, and of course it is, but there's a lot of flow-on effects that I don't think a lot of people talk about.
Yeah, and both of you are hitting on the same point that keeps coming up is timing and how important timing is, right? And so when you're planning an exit, what are some indicators that people, how do you know when it's the right time to exit?
I'm a big believer in what I call the musical chairs approach. I think you need to make sure that the music's going to stop at any one time and you don't know when. You need to make sure there's a chair. And so I think that sometimes founders get themselves in a spot, they only see one possible outcome. And I've only learned the hard way over 27 years that you need to be prepared for lots of outcomes. And, that means that, sometimes markets change. Sometimes there'll be, really massive disruption in a technology stack. GPT probably personally bankrupted 5 or 6 of my buddies' companies that had been doing long form AI development for a long time, and it became irrelevant overnight, right? So I think you need to always be reading the tea leaves. I think the diversity of the technology world is going to go into hyperdrive in terms of how fast it's going to change. And so your assumptions that you made 2 years ago or even 2 months ago may be irrelevant. So you have to be constantly refreshing. How do I see the current trajectory of the company? You might be killing it on sales for a few quarters, and then you might hit some headwinds, and you might have to figure out why. Is it just industry, or is there a competitor in the market? Has something made your industry that was very lucrative suddenly free to most people? I think those are the things that as a founder you need to factor into your calculations. And you have to be careful for what I call intoxicating beliefs, where you're so convinced of nothing but greatness that you can't see what if, right? I think there's a lot of opportunity to disrupt a lot of industries as a startup, but at some point, you also need to figure out how do you scale the biggest level. And that might mean that you bring in $1 billion or you go public, or in a lot of cases, an acquisition is a means to an end. Yeah, you get cashed out and your stakeholders make some money and you make some money, but it also might be a way to bring your technology and your product to life globally. Good acquisition can accelerate what you're trying to accomplish. I don't think there's a one magic answer to the answer of when. I just think it's more about the magic answer of, are you do you have a 360-degree view of all the factors? You know, what's going on in the market, what's right for you, what's right for your shareholders. I mean, I personally have gotten to a spot where I believe that getting to a healthy exit is fantastic for you and your shareholders. There's nothing wrong with that, and it becomes riskier and riskier to bet for the biggest stuff, right? But I also think it's just really fascinating to unpack some of the really famous stories. I mean, Zuckerberg went to see Bill Gates in Seattle, and they're sitting on their yacht, and Bill's like, "I'm going to give you $1 billion cash for Facebook." Being offered $1 billion cash for your company, take some cojones to say no to that, right? But I don't think that Zuckerberg in particular had cojones. I think he had understood exactly where his business was going. I think he understood that he was just 1/10 of 1% into his growth. And maybe he's not really a gambler, but he just knew even if we fail horribly, this thing is going to go up 100x from where I'm at now. The numbers are going to change. Right. And so if you know that, if you truly know that, and you're not just being overly optimistic, then I think those decisions that might seem really ballsy at the time, they may not be so much. They may just be informed decision making, you know?
Yeah, Andy,
Yeah.
do you want to add any thoughts on what are some of the indicators about timing and when is the timing right?
Yeah, definitely. And I think that being able to look at patterns within your business, like what Mark talked about as far as some of those data metrics, like when you're starting to see like very large shifts, particularly over a short space of time, and that could be on margin, it could be on revenue, bottom line. There's things that you're tracking in your finance documents like on a pretty regular basis, and you start to know that, you start to see cycles across years, months, etc. But also the bigger thing too is macro trends. If there's a change in government, which we've just gone through now, and whatever happens in January, like there's things at that level, there's global events which can shift things as well. Sometimes they're completely out of your hands. And, you know, you look at something like COVID and what that did, it created new businesses and also collapsed others. So it's stuff that you can't plan for. And I think the pragmatism side of it is from a financial perspective, like, are you just chasing the biggest dollar value because it feels like that's what you should do? Or can you be pragmatic and just go, like, we're actually getting a good deal out of this. This is life changing and it's going to set us up. So maybe it is the right time. But the third one that I would add to that, which I've found fascinating in talking to exited founders, is someone who built, like, a real story as well, someone who built their dream business and they worked in it for, I think, maybe 12 years, had a really good exit, and then had to lock in for a period of time, saw the culture change, saw the business change, and really struggled with what their company had become. And the money, what he learned through that time was great, but ultimately, like, his passion was building the business and being in the business. And post exit, when he actually was able to leave the company, working out what he did next, he really struggled for a few years in trying to sort of find a new passion and a new business. So it's sort of like, money's great, but if you're someone who's done a startup, you're typically wired in a certain way, and you just can't help but get your hands dirty and want to find your next challenge. And, you know, thinking about the post exit thing, like, you might have a yacht and a nice house and be traveling around the world, but I think for those people that are traditional startup founders, that's going to wear thin after a period of time.
And the question that I wanted to follow up with you on that with Andy is I'm getting the sense that, like, timing is going to depend on a lot of different factors, right? But for founders, let's say they decide that they do want to exit, right? And now they're in the thrones and you're in due diligence, right? There are some things that can happen during due diligence that can catch you off guard as well, right? So talk to us a little bit about that.
Yeah, and it goes back to my first point that we started with around, from day one, it's decisions that you're making. And I was coached, thankfully, to have regular board meetings, have agendas, have minutes, documenting key decisions that were made from a strategic point of view, anything that happened from a legal standpoint, having all that prepared. So unbeknownst to us, we were literally building our data room as we went, and it wasn't something that we had to do in a mad rush at the end. So all those things were tracked. So I think being able to understand sort of what things they're looking for, and it feels like way ahead of yourself. But my experience, I've had good experiences, thankfully, but I've also heard, you know, terrible experiences where people don't have information and it's collapsed what would have been a good sale with what, you know, takes probably 3 months on average right now to go through that process, the hours and time that you burn to not then get an exit. So again, it just pays to be buttoned up all the way through the process on what you're doing. And I think that will set you up. One, it positions you as being someone who is organized, which helps with the sale, but two, it streamlines that process.
Yeah, I was the same founder that I was talking to. She was saying that they were in the process of doing due diligence, and they discovered a legal issue that hadn't been disclosed, right? And so here they are thinking everything's looking great. We're almost there. And then this thing shows up during due diligence, right? And it really could have derailed the deal. Luckily, they were able to resolve it pretty quickly and negotiated a separate agreement. And so they were able to get around it. But it's a reminder, right? Like, don't leave any stones unturned during your preparation process, and be ready to go if something does come up, right? Mark, did you want to add anything?
Yeah, no, I mean, I would echo what Andy said. I think that is an example of being prepared. I think it's just good practice to make sure you have data rooms set up from the very beginning. Something that we have done at a very early stage, even our youngest companies, we set up a data room with all our documents in one spot. It's good for acquisitions, but it's good for financing. It's good for raising debt, for banks, for anything. It's a good practice to get into, just thinking about, how you would turn over the keys to the castle for someone to quickly understand where you're at. I think the way you avoid those landmines or the things that were undisclosed is you really have to embrace an era of transparency, right? People forget that most acquisitions are just as much a hiring decision as it is an asset acquisition, and I think in that case, transparency always serves you as well. Like, you're good, bad, and the ugly. You can have scars, you can have things that are not so perfect in the overall story or the current realities. But I think by being transparent and disclosing that, you also disclose the kind of person they'd be working with or the team they'd be working with. And so you avoid those kind of landmines if you're not overly selling a deal and you're just telling your truth, then nothing really blows up in your face. So I just think that's super important. I also think, I'll just go back to my previous example. Those things change when there's a stalking horse. And a stalking horse just means there's another option. So I really do believe anybody who's going through an acquisition process, whether it be intentionally or otherwise, you have to create a second option. So the example I gave before was they'd raised additional capital. So their story was, well, we can grow for the next 3 years and probably increase our value 10x. Why would we take your offer now? And that forced them to increase their offer, right? And so I think you have to create those. So due diligence can be short-circuited in a lot of ways if you've got alternatives that, are also competing for the deal. And I think that's super important, just to keep people honest. One of the things I've said openly about most financial transactions, this is financing and it's, acquisitions, is time is the enemy of most deals. So the more time people have, the more time they have to ask questions, the more time they have to have doubts, the more time they have to get to know you and your team, the more time they have to wonder about the certain person or a certain decision. And now you're like, married but not married. You're not having the fun part of being married. You're starting to act like you're together, but you're not quite together, and it just destroys deals. Some of the acquisition conversations I've gotten into is folks that really love a technology I've built, and they want to have an exclusive conversation. And we'd really love, we're the perfect partners for you. Why don't we do some kind of exclusivity, in this category? And my favorite answer is, well, there's only one way to get exclusivity. Otherwise, we'll be good partners. And you also know the other people I'll partner with, right? So how important is exclusivity to you? And so, I just think you need to figure out what you hold close to your chest, what you don't. And you got to be careful not being too open and not letting the deal get ruined just by too much time going by.
Yeah, you're really reminding us of the importance, Mark, of having backup options and making sure you have other, plan B, plan C in case these kinds of things go south, right? And so that leads me to my last question. Even the best laid plans can go sideways at any point. And so, any lessons that the two of you've been around the block, what are some of the lessons you could share with us for when you're in that situation and something falls apart last minute and you don't maybe have that backup plan?
Yeah, one thing I would say I think people miss in this, and most people know sales in some form or fashion if you're in the business world, right? I think people forget that an acquisition is a sales process. And so what usually goes wrong in a sale, forget an acquisition. You're just selling your product. It's because you don't know who the decision makers are. You don't know who controls the budget. You don't really understand what happens if they do or do not buy your product. And this is just general sales, right? You're trying to sell a piece of software, and you have to ask yourself, I've managed sales teams my whole life, and you have to ask them, well, what happens if they don't buy? Who decides? Where's the budget coming from? Do they have a timeline? Do they have to decide now, or do they can decide a year from now? Those same questions need to be asked in acquisition. So you need to understand the psychology, the decision-making power, everything within the potential acquirer. Just as important, you need to do a sales process internally with your board and the rest of your team. So there's two things that can ruin an acquisition. The acquirer, whatever, someone doesn't agree, doesn't like you, whatever, likes a different company to acquire, doesn't believe they should acquire at all. You need to understand all that. But internally, I had one particular deal get ruined by a board member. And so we had a very attractive offer at a young stage of a company. And he, rightfully, like all of us, thought we could go to the moon. But going to the moon still is full of risks and assumptions and unknowns and, a decade worth of, unknowns, right? Meanwhile, we had a very early stage offer. I would say it's an overture. It wasn't like a solid offer, but it was a very strong overture floating out a number and a timeline. If we could pull this off, would you guys be interested? And we took it to the board, and it was just nothing but, absolutely freaking not. What do these guys think we are? These guys are crazy. Tell them to pound sand. Like, really, arrogant response. And in hindsight, that particular deal did end in an acquisition, but not nearly what he had hoped or what we would have hoped in the biggest scheme of things. And in hindsight, that first offer would have been the best possible outcome, right? And so I think you have to realize that it's not just trying to get the acquirer to stay charging. You got to make sure you're working your internal founders and board that something can get across the line. And if you don't put that effort into it, just like any sales process, you're probably just wishing on a hope.
Yeah, I love hearing that. I listen to those kind of stories all the time, like the real life stories of people's pieces. This is not my story, but it's a well-known one. And I think it goes back to investment contracts. So when you're doing investment deals, there's two things at play. There's obviously dilution, which changes the voting structure. But there's also the language as far as the type of shares that investors have in your company and that founders have in your company. Then you have shares for your team as well, from an ESOP point of view. So all of these things have different voting rights, and you need to be really careful and aware that when you go into an exit, understanding who has what voting rights from an investment standpoint and from a founder standpoint. And the one that became famous over the last 12 months was FanDuel, which sold for roughly $500 million. And the headline was that the founders came out of that deal with nothing. And the main reason was that they were carrying so much debt. So when you've got a business like that as a tech platform, quite often you're putting capital in to grow market share and you're creating future value. But at the time that they were sold, they were basically paying off all their debt and they walked away with nothing. But if they had more control in the voting situation, it wouldn't have ended up in the same way. So ultimately, the VCs that were in their business had voting power and were able to get capital back out that they wanted and left the founders with basically nothing. And it's, for me, there's a lot of lessons in the co-founder agreement at the start, but then also your investment deals to set up an environment. To Mark's point about one board member, they're like, who are the people around the table that can make a decision whether you sell or not? How does that play out in the sense of escalation where you can't actually get to a resolution? There's a lot of things there that you need to be really organized on. So future planning going to an exit starts on day one and it goes right through any sort of contract revision and evolution of ownership.
Thank you, Andy. What you're saying is resonating, and we've got Jackie. I want to give a shout out. Thank you, Jackie Righty. She's listening in from Ireland. So thank you for joining us. That's awesome that you're signing in from there. I was going to stop there, but I've got one more follow-up question for both of you, because this is an issue I think that comes up for a lot of founders, right? Is how do you value what your company or your startup is worth, right? And so a challenge a lot of the time is overestimating the company's worth, right? And on one hand, you have this issue of optimism is good. You still want to make sure it's based on realistic metrics. But on the other side, I've seen situations where founders sometimes undervalue themselves out of, fear of losing the deal, right? So I would love to hear both of your thoughts on that last one.
Yeah, that's a big one. So like there's different ways you can do it, of course, but looking at fair market value comes up through any stage in the business as far as investments at different points. And you see VCs invest, and it could be an early pre-seed or seed round right through to Series CD, where you're starting to get a sense of valuations. And I take most of those numbers with a grain of salt. Like what you're valued at the time of investment can change, and we've seen down rounds recently as a result of that. But I think for me, the key part is sort of one, getting internal alignment from a contract point of view about how you as partners are doing that, but also any external measures. So there's people that do it at a professional level that can give you that right base point, but also appreciating you're going to have negotiation that happens through value. And there's things about how much debt you're carrying, future growth. There's so many variables that go into that. And I think that the actual price, it's really hard to lock down, particularly in certain categories. If you're in a deep tech business and you're creating a future market compared to like a service business where it can fluctuate, there's a lot of different variables across category as well. So understanding that and having a good sense of where you sit alongside probably other benchmarks as well. So other businesses that have sold or had investment in similar categories to yourself that you actively use to sort of get a sense of where you're at, because there's no perfect science to it. It's a moving number all the time.
Yeah. We'd love to hear from you on that one too, Mark.
Yeah, I just think it's a lot of variables. To Andy's point, there's so many variables. I think it's actually a bigger risk that most founders undervalue themselves. I think what you have to do is make sure you have good comps. So if you think of like real estate, you'd compare yourself to a similar size home in a similar neighborhood and what recent sales have taken place. I think that's always important to help reset the market. But I think growth is super important. I mean, it's rational to go through business school and say, well, I'm going to value this company based on a multiple over earnings. But a lot of companies, especially in technology, will lose money for a long, long time. And its value to be acquired a lot of times has to do with traction or user base or growth trajectories, right? Amazon infamously got to, I think, $100 billion in value before they made really any profit. So you can create significant value in your company and not be able to point to a profit number, but you have other metrics. You have user growth or you have sales top line growth, just not bottom line growth. So, I just think that there's no one formula. I think like anything, you might take a couple different approaches to establishing the value. In a perfect world, 2 or 3 different approaches still establish a value that's attractive to you. But again, I do think, very big difference between like a service business versus a technology business that's disrupting a market. So, there's no one answer, but there's, I do think it's important to have third parties come in that advocate for you, because I do actually think it's a bigger challenge that co-founders undervalue what they have. And with a few, tricks of the trade or finding good comps or finding a stalking horse, whatever, if you're in play, you can significantly increase your potential exit to you and shareholders by being smart.
Awesome. Well, thank you both for such incredible insights. And thank you everyone for joining us. I hope you learned a lot from both of their wisdom and experiences that were shared today. So next week, just so you know, we are not going to be having the making of a Nobody live stream. We're going to give Andy and Mark 1 week off, but we'll be back the week after Thanksgiving. So we continue to explore different topics that relate to the venture studio world. And if anything that we talked about interests you or you want to learn more about Nobody Studios, please check us out on our website at nobodystudios.com. All right, everyone, have a great week.